Welcome to TMS Insights. It's early in September. Jeremy Hook and Ben Clark bringing you another update of the market. We've had reporting season that's been and gone, and it was an interesting session. Ben, 78% of companies met or exceeded the guidance and expected earnings, and a number missed.
Yeah.
It's interesting how their share prices collectively react in the aftermath of reporting. Quite divergent performance based on reports.
Yeah, definitely. I mean, I think you've got some stats there with you, Jeremy. I think looking as a whole, you'd have to say it was a bit underwhelming reporting season. I think for every stock that's beat expectations, there were two that missed expectations. But at the same time, the vast majority of companies met expectations. And really, a lot more attention, I think, was put on the guidance for the year ahead as opposed to the numbers that were recently reported. But certainly there's some strong evidence that those that can beat expectations do pretty well in share price reaction following on from that.
And to that extent, that companies that do exceed expectations perform 11% better than the average stock in the market in the months that follow. Stocks that perform in line with expectations rise by 3.3%, and those that fail to meet expectations on average fall by 6.3%. And why that's important, Ben, really is that once you hear a good result or a bad result, often an investor will think, well, the opportunity's been lost to either get on board a stock going well or get out of a stock going badly, but that is not borne out in those numbers.
No, there's normally a small hit, I guess, in a positive or negative sense, but over the next sort of 5 months, and I think that's when that data goes back to, is back in February, in the February reporting season, there's that continued positive performance or negative performance. Yes. And it makes sense, really, when you think about it. I mean, the company's share prices are following the fortunes of that company's profit stream, and you do often see it. So it can be hard to sort of think, I want to buy something that's done well, and vice versa. But history tells us it is the right decision to make on a shorter sort of term basis.
Yeah. Look, and each case obviously has some differences, but it's good to have that in the back of the mind when we try to work out what we should be doing. Ben, this time of year tends to throw up ex-dividends, so there's some leakage out of some share prices that goes into cash accounts and the like. And often September is a weaker month in US markets and also here. It's created a few opportunities in a few of the stocks we like.
Yeah, I think so. I would say, I mean, the thing that comes back to me looking at an overview of reporting again is that there are an increasingly smaller number of companies that are having meaningful revenue and earnings growth. And by and large, the market has priced that small club of companies on quite high multiples. And you've really got to be quite quick, I guess, or you've got to be, opportunistic to find the ones that you think have pulled back. And one we highlighted on a couple of weeks ago, we won't go through it again, but is Vocus, which we think, can generate sort of 20% rough earnings per share growth in the medium term, and is now trading on a PE of sort of 18.5, 19 times. And, there's some reasons why that stock's come back, which we think are explainable and unrelated to the fortunes of the business.
And particularly there, and then it's a good one for learning beyond just Vocus itself, that stock was sold by key people, directors, senior management. At first glance, that would appear to be not a good thing, but very understandable reasons that they might want to let go of a bit of stock to buy a property or what have you. There's normal kinds of events, and that's been the case here with Vocus.
Definitely. There were 5 founders of Vocus. I think it was 13 or 14 years ago now, and 2 of those founders are no longer with the company, haven't been with the company for some time, have a significant amount of their wealth tied up in Vocus shares. And this is because Vocus has done a number of acquisitions in the last 18 months. There's actually been a director freeze on buying or selling for that period, and this has been the first window that directors have had to be able to transact. So there's 2 founders who left the company over 12 months ago now, who have sold about $50 million of stock each, which is a large amount for the market to take. And also, I think, throws a few, are they selling for a reason, which we think they're not. No. And there have also been other directors buying at the same time. So, I think this is when you get the opportunities, is when you think that there's something that's happened that isn't related to the company, and yet the share price has reacted like it is.
Yeah, exactly. They're just doing what we're advised, which is diversifying your assets, which is
Right.
great. So another rocky ride on Blackmores, and again, not to necessarily labour it now. We have talked about it, throwing up opportunities because of expectations and guidance not being as positive going forward, but still a very good story overall.
Absolutely, and we've sort of met with the company since we I think last spoke, and we think that this is a market that's going through phenomenal growth, structural growth, and there's growing pains, and that the market is changing very rapidly, and the company is going through periods where it's having to change quickly, but when you're looking at quarter on quarter on quarter numbers, it's going to be reflected. And I think we're going through that at the moment. But ultimately, whilst also still saying that we expect this is going to be a very volatile share price, it's not one you'd have a whole lot of your account in. The future demand for these products is looking very promising, and Blackmores, we think, have a management team and a brand which the Chinese in particular very much aspire to, and some people there that will steer the company along this path. So still really like it. Probably thrown up, I think, a good buying opportunity with a 3 to 5 year sort of view. I think, again, it probably falls in that basket, don't it?
Yeah, absolutely. And just in the wake of reporting season, analysts relook at their numbers and make changes to their forward-looking numbers. The big areas that they seem to have been increasing numbers for are both building materials, which reported well, and resources, which obviously didn't report well on a weaker period. But the numbers for the 17 year are now looking like the strongest earnings growth area of the whole market. So a different way for people to potentially think they've been.
Yeah, I mean, it's crazy, isn't it? And really what's happened is that a lot of the pain has been taken by the resource stocks now. They've managed to get their costs under control, balance sheets are back in good order, commodity prices for now are very stable, and these businesses are suddenly very profitable versus last year's earnings, which were not profitable. So the market gets a kick from that, or these, in terms of the overall earnings growth that it will generate this year. Building products, I think, really relies on that continued strong momentum in the building cycle, and we know that is a cyclical area of the market. The other area I thought was very good was retail stocks.
Yes.
There was a number of really good results in the retail area.
JB, Harvey Norman.
Baby Bunting.
Yes.
There was quite a few businesses there. And, I think it probably points to the fact the economy is going a lot better than people give it credit for. Because when people are spending, I think it's a good indication of what's going on.
No question. Well, that's all we've got time for today's insights. We'll look forward to bringing you a further update next month.